Hello, everyone. We are a group of share market traders who are trading with a capital in excess of 1 crore, and we are making continuous profit for the last 4 to 5 years. As the pandemic situation started in 2020, many people started losing their jobs, and many people who I know in my society and who are close friends of mine are also coming to share market. But the problem is many of these people are just losing money. A friend whom I know personally lost 25 lakhs in a span of 4 months. So we thought, since we are doing this for a long time, and since we have good understanding of what stock market is, we thought of doing a educational video series to help people make profits from stock market. So this is the first video in the stock market learning series. So let us begin by understanding what a stock market is. So stock market is a place where people can buy shares. Think of it, analogous to the normal or conventional market that we see. In a conventional market, you go and buy commodities. Commodities can be, the vegetables or the meat or whatever that you can buy. Now, the analogy that I am drawing is with shares. In case of a stock market, you're buying shares. Share is nothing but a definite proportion of a company's value. So you're paying for the company's percentage ownership, and they give you share in return. We'll go to this in detail, but for now, let us understand financial market is a market in which people trade in financial securities, commodities, or value at low transaction cost and prices that reflect supply and demand. Financial market help people trade in stocks, securities, bonds, precious metals, and agriculture products, which are called commodities. So these are the primary components of a financial market: equities and bonds, securities, currencies, and derivatives. Then types of financial markets are money market and capital market. Capital market is further subdivided to primary market and secondary market, and secondary market is further subdivided to stock market and OTC market. We will come to all of these in depth in the upcoming videos. Let us first understand what stock is. Let's say you have a vegetable shop and you evaluate the company the overall value of the vegetable shop to be 1 lakh rupees. Now this 1 lakh rupees is overall worth of your vegetable shop. Now let's say you are having two brothers, so including you and your two brothers, this is equally owned by you three. So let's say the company is having three shareholders, and each share is worth 33,333.33 rupees, which means one third of the total valuation is the price of each stock. Now think of it like this: you want to sell some portion of your business to raise some capital, and the objective is to expand your business. So what you can do is you can issue 100 shares, each worth 1,000 rupees, making up this 1 lakh, and you can sell what proportion of this share you want to. Let's say you want to raise to 20,000 rupees, so you can share 20, you can sell 20 of these shares with 1,000 rupees face value each. So this is called a stock, and this is called a share. So you can use your capital to buy the shares of the company, and they issue you share in a return. Then whoever holding a share is called a shareholder, and shareholders are partial owners of the stock. So since the stock is of a company, you are in turn a partial owner of the company. So we will summarize what will we discuss in the following, in the previous few slides. So a place where share of public listed companies are traded is called stock market. The primary market is where companies float shares to general public in an initial offering called IPO. So IPO is the very good time to buy shares of good companies. At the time of IPO issuance, a lot of people bid for these IPOs, and at the time of these shares being listed, there is usually a surge of 25 to 30% in share value. This is a very easy profit that you can make over a period of 2 to 3 weeks. So we will come to all of this in the following videos in the series. Then stock market also facilitates stockbrokers to trade company stocks and other securities. A stock may be bought or sold only if it is listed on an exchange. An exchange is nothing but a regulatory body that regulates the selling and buying of shares. Then the meeting place of stockbrokers and sellers is stock market. India's premium stock exchanges are BSE, which is nothing but the Bombay Stock Exchange, and NSE, which is nothing but the National Stock Exchange. Now, this is the importance of stock market. Stock market is important part of country's economy. The stock market exists so that companies can raise money without incurring any debt. And in return, these companies issue shares, which is known as initial public offering. And if there are more people buying a stock than the people selling it, the price goes up with demand. So share market works on the basic principle of supply and demand. So the principle of supply and demand says that whenever the supply of a material exceeds, the demand, then the value of the item will come down. For example, whenever there is a harvest season, there is abundant supply of vegetables. For example, we can take tomato. In harvest season of tomato, there is abundant supply of tomato, but the demand more or less remains constant. As a result, the price of tomato decreases nearing the harvest season. On the other hand, when there is a famine, or when there is a drought, what is going to happen is there will be lesser supply of vegetables. In our example, there will be lesser supply of tomatoes. So what happens is there will be a surge in price. So when supply comes down, as the demand is remaining constant, the price of the commodity will go up. This is a classic, example of supply demand, and trade market works on these principles of supply and demand. Whenever there is a higher supply, or let's say a higher, free shares of a company available, the company will be trading at a lower price. And whenever there is a demand, or people wanting to buy the shares, it's gonna go up. So if you club supply demand to share market, it will be very easy for you to make profits. This is how share market works in a nutshell. So the company lists itself in the exchange, which is nothing called an initial public offering. Then there is primary market, and the company issues IPO. Then shares are distributed, and secondary market trading begins, which happens after IPO. Then there are two other important concepts that you need to learn to be, able to become a profitable trader. One is, what is a bull market? A bull market refers to a market that is on the rise. There is a sustained increase in the market share prices. Investors often have faith that the uptrend will continue over time, and it is, expected to be long term. Typically, in this scenario, the country's economy is strong and employment levels are high. After the recovery from Corona happened from 2020 September onwards, Indian share market is on a bull run. Though we had a small downtrend in the March and April of 2021, we have recovered, and Nifty is now rallying towards 16,000, which is going to be very good for the economy. So we can say that we are in a bull trend now, and this is the best time for people to come to market. Then, similar to bull market, there is something called bear market. In a bear market, it's a general decline in the stock price, and share prices continuously drop, resulting in a downward trend. Investors anticipate losses and selling increases. Typically, economy will slow down and unemployment will rise. So, a typical investor is gonna earn profit only in a bull market and will lose in bear market. But what we will be covering over this video series is strategies to make you profitable both in bull and bear market. So please do subscribe to the channel, continue watching all the videos, and improve your knowledge in share market. We together can become profitable. Moving to the other section, we will now help you to understand what Sensex is, what Nifty is. Sensex is nothing but the index of Bombay Stock Exchange. It was initially compiled in 1986 and it is the oldest stock index in India. It is composed of 30 largest and most actively traded stocks on the BSE, and this provides an accurate gauge of India's economy. Analysts and investors use the Sensex to observe the overall growth, development of a particular industry, booms and busts of Indian economy. Then we go move on to Nifty. Nifty is National Stock Exchange, index of that, and it is benchmark based on stocks market index for Indian equity market. It represents the weighted average of 15 Indian companies in 12 sectors. It is one of the two main stock indices used in India. Now here Nifty follows a weighted average, where higher weightage is given to few companies. Uh, I will consider the case of two companies, namely Reliance Industries and HDFC Bank. These companies have a higher proportion of weightage in Nifty. Nifty 50 index is a free float market capitalization weighted index. Now, what is an index? That is something which many tutorial videos skip, and because of which people don't have much understanding of what an index is. Index is a tool which measures change. For example, consumer price index measures inflation. Also, human development index measures development of a country. Now, to understand the index, we have brought in Sensex and Nifty. Index is nothing but understanding of how well the market is doing. Now, calculation of index value. As we already mentioned that Nifty uses a weighted average. Each stock has a different price average. And so each stock has different weightage in the index. For example, let's say we have five shares, A, B, C, D, and D, having a cost of 1000, 2000, 500, 700, and 800 respectively. If we have an equal weightage of 20%, the total index will be average of all of these values, which is basically 1000 plus 2000 plus 500 plus 700 plus 800 by 5, which comes to 5000 rupees. Now, on the other hand, if you're losing a weighted average, then the total will be the sum product of all these values, which is 22 into 1200 plus 1900 plus 700 and so on. So it comes to 5400. That is how we calculate index. Yeah, so that's all for today's video.